All right. Good morning, everyone. We'll bring the subcommittee, the Property and Casualty Insurance Subcommittee, to a beginning here. And today's agenda, we have two bills on the agenda. Why don't we go ahead, Bob, and start with House Bill 563.
Okay, House Bill 563, Mr. Chairman, is your bill on the surplus lines brokers fees. Initially, the bill came in. I guess current law has what, a $250 cap on the fees, and the bill came in taking caps off entirely. And I believe there's been some negotiation back and forth with the Senate and the people in the industry, resulting in an amendment which should have been sent out as House 0563 573828. Amendment 1 is technical, and amendment number 2 essentially brings up a cap of $500 or 7% of the policy premium, whichever is greater. I believe there may be a couple of industry reps here who might be able to discuss exactly how that impacts the insured community as well as the insurers.
Yeah. That's correct. We have Mr. Brett Leininger here with us, but who can explain that. First, I'd like to ask: are there any questions from the committee members? Specific questions about the bill. I will say this, and I'm going to let Mr. Leininger speak in a second, but I do know that they did meet, they did work this out, they came to a compromise. I see Delegate Turner. You have a question.
Could one more time? I think he said $500, and I missed the last little bit with that.
It's the greater of $500 and 7% of the policy premium, whichever is greater.
Yeah.
So there is a cap, but if you have a humongous policy premium, it's not capped at 500 for that. This is, after all, surplus lines. This is outside of the regular small domestic market.
So, thank you very much. Thank you.
You're quite welcome.
Yes.
Mr. Leininger, would you like to say a few words about the bill?
Sure thing. Thank you. Brett Leininger, on behalf of the Wholesale and Surplus Insurance Association. Maryland is only one of 4 states that has any cap at all for the fees that a surplus lines broker may charge. The bill, the amendments Mr. Smith articulated correctly for commercial lines to increase from the current $250, which has not been touched since 2001, to 500 or 7% of the policy premium, whichever is greater. And for personal lines from $100 to $200, also hadn't been changed since 2001. I think Mr. Popham gave a history lesson during the hearing that the reason that there is a cap at all in Maryland was about 25 years ago. The Maryland Insurance Administration came to the industry and said that if you want to charge a fee, we don't have a problem with charging a fee, but it has to be specified in statute. So that is why there is any kind of cap, and it was set at a static fee. I think it was in 1997, and then touched again in 2001. So here we are in 2022, Maryland being one of 4 states that has any cap at all. And I'm happy to answer any other questions. I should say that with respect to surplus lines, again, this is when the standard market cannot fill the need, will not write the risk, if you will. And there are a number of things that the surplus lines producer, broker needs to do that would be normally taken care of by the standard market carrier, which would involve premium tax reporting and filing and some other regular reports, and as well helping to find where to place the risk in the non-standard market.
Okay. Thank you. I see Delegate Ahrens has a question. Delegate.
Yeah, just real quick, give me an example of a non-standard someone.
Well, commercial, I think one of the examples that was brought up in the hearing was just think of the Maryland Inn. It's an old historic building. A lot of the buildings, commercial buildings in Annapolis, for example, would be something that would not fit within kind of the general confines of what the standard market would be comfortable in underwriting, just because of all of its old, just many different characteristics about the location that would require it would be a situation where the standard market would say it just doesn't fit within our kind of parameters, and the non-standard market will fulfill that void.
Okay, I see Delegate Watson has a question. Delegate?
Okay, sorry, I was muted. So another example of a surplus lines sort of risk would be, for example, a tavern with a lot of alcohol sales or dancing or some kind of risk that standard insurance companies don't like to do. Roofers or temporary staffing agencies, things like that. But the question I'd like to ask is this. Typically, the surplus lines insurer pays a commission to the wholesaler broker. And so they're not just getting the $250 fee right now. So the question is, what is the average piece of the commission that they are keeping? Do any of the industry reps know the answer to that?
I do not know the answer to that.
So I guess the question that I have overall is why we are going with a 7% fee versus just using the $500 fee and allowing them to continue to take part of the commission that comes from the surplus lines carrier. So those who may not know how it works, and somebody on the industry can correct me if I'm wrong, but the surplus lines carrier pays a commission to the wholesaler, and the wholesaler takes part of that commission and then passes on part of the commission to the retailer, basically. And so that is a percentage. So a retailer might get 7% commission on a surplus lines policy, or they might get 12%, or they might get 10%, with the wholesaler retaining part of that commission. Commission is based on the total sale, so it will go up. If premium's $50,000, they'll get a lot more of a piece of that than if it's $5,000. So I guess what I'm asking is, before, when we originally drafted or wrote this law, we didn't account, or we didn't allow for a commission-based fee to be charged, and now we are. And so I want to know why that has changed and why we just don't go to a $500 fee.
Static fee. Well, I think it's because, again, historically, the reason there is a cap at all in this state is back in '97, the Insurance Administration came to the industry and said that if you want to be able to charge a fee, it needs to be able to be put into statute. Maryland is, again, only one of 4 states remaining that has any cap at all. And to my understanding, there is no issue with respect to, it's really the market controls what fees are being charged. So this just gives their more flexibility instead of just an arbitrary number for a static fee.
Okay, so keeping in mind that excess and surplus lines premiums are usually higher and expensive for the average business out there that might need to go to that market, we would be increasing the cost on these small businesses that need to go to this market. So the question I have for you is, what is the insurance commissioner's position on it? What kind of talks did you have with the insurance commissioner before bringing the bill forward? And are they present here now?
They are present, and I won't speak for them, other than to say that we have had many conversations.
Okay, so I guess, Mr. Chair, it would be helpful for me to hear from them.
Yeah, we have the person from the insurance commissioner. Let's hear from them.
Hi, I'm Kathleen Borain, and I'm the insurance commissioner, and thank you for inviting us today. Delegate Watson, we did have conversations with the surplus lines groups and with industry, and we looked at the other states that address this issue. This model of the alternative of a cap or a percentage, it was something that other states, the few states that do cap these at all, do incorporate. This deals with commercial lines. These fees are, what the fees can be used for are limited in scope. They have to relate to specific things within the statute, and they apply whether it's to relatively small businesses or much larger businesses. So what it does is, and they're negotiable. So the sense was that given the amount of time that's gone by since the last time that they were increased, we felt that it was reasonable, and we did not object to the increase of those fees. And the idea of a sliding scale that's premised on premium, not the coverage, but the premium, also was in line with what other states were doing. And the amount that I believe has been negotiated down from where it began with. The original ask was to completely get rid of the caps so that it would be like, the majority of other states. But we felt that that was unreasonable because that would put too much of a burden on businesses. But the idea of increasing the cap and having it be a sliding scale based on the premium amount seemed to be in line with what other states, those few other states that regulate the way we do, are doing.
Okay, thank you for that answer. And do you know what the average percentage fee is with the other states that do this?
I don't have it at my fingertips, but my recollection is that it was between 5 and 10%, but I can get that data for you.
Okay, thank you very much. Thank you, Mr. Chair.
All right. Are there any other questions? Seeing none, is there a motion, though, to move this bill out to the committee?
I move approval of the bill.
I'd like to make a motion to move it.
The amendments.
Second,
So I guess we have to amend the bill first, right, Bob?
Yes.
So is there a motion to adopt the amendments?
I make that motion as stated.
I second.
Okay. It's been properly moved and seconded. Do we do a roll call, or can we just do a
Voice vote on the amendment.
on the amendment? Okay, all those in favor?
Aye.
Aye.
Any opposed? Amendment carries. Okay, on the bill as amended.
Okay.
Move the
we
bill as amended.
Okay. Generally, we haven't been taking an actual roll call, but if there are those in favor and those again, then we get a count of those again.
Okay, so is there a second on the bill?
I
Second.
second it. Okay, go.
Okay. So I guess so what you're telling me, Bob, is we do a roll call?
We do a roll call, but I don't record names.
Okay.
Okay.
Ned, why don't you just ask if anyone's against?
Let me ask you this. That's a good, thank you, Delegate. You're right. Is there anyone against the bill? Seeing none, everyone present voted for the bill, Bob.
Okay. Yep. So it is, and there's only one absent. So.
That is correct.
Mhm.
Okay. All right.
Okay.
Let's,
Next up, 926. Okay, House 926 was heard from Delegate Valderrama. This is the mechanical repair contracts, insurance reserves. It was actually heard as a business regulation bill, but when the bill was heard, it was realized this is more of an insurance bill, so it got shifted over to this subcommittee and to me. What the bill does essentially is to authorize risk retention groups to provide insurance that is currently required to be done by either an admitted or a surplus lines insurer. This is for policies relating to mechanical repair contracts. I know there were some questions as to what a risk retention group is. We actually did a cleanup build in 2018 to maintain accreditation with NAIC to update our risk retention group laws to comply with the NAIC model. These groups are essentially industry-owned captive insurers that became authorized under federal law in the early 70s in the midst of a product liability crisis at the time, and they've since broadened to provide more general commercial lines insurance in the states where they are authorized.
Okay. Are there any questions about this? So Bob, I guess I have a question, and I see that Ms. Harding is here with us this morning to answer some questions. I guess the first question I have is, so this policy that you buy, is this when I buy a new car, I get this, I get this maintenance policy, or are these the people that constantly call me on the phone asking me to get a maintenance policy?
Delegate Carey, thanks for that question. And no, these are service contracts that typically you wouldn't buy with maybe a new car. You can, but I think most often you will see them sold in connection with a used car. I can speak from personal experience. I bought a car a few years ago that ended up being a complete lemon, and thank goodness I bought a service contract because there were thousands of dollars worth of repairs on the vehicle that were required because it was burning oil. But it's a totally optional product. You would typically buy it. You can buy it at the time of sale. I think it's available afterwards. And it is basically covering repairs and replacements when there's an operational or structural failure of the car. We regulate them under Maryland law already, with the Insurance Administration being the principal regulator. And there is this requirement that the bill gets to, that the company that sells them has to have a comprehensive liability insurance policy, a quote unquote CLIP for short, to make sure that if there is a covered claim that for some reason the company doesn't pay in the required time, that the consumer can get their claim paid by the insurance company. And the bill leaves that in place. It just clarifies the type of insurance policy that would satisfy that requirement. So it's really sort of on that issue, totally intended to be clarifying in nature.
Okay, I see we have a question from Delegate Fennell.
So I just heard you right. What you're saying is, no matter what, when the consumer, this policy will cover the consumer. That's what I'm hearing?
Correct, Delegate Fennell. This doesn't change the backstop to make sure the consumer is paid in accordance with Maryland law. It's the technical nature of the CLIP that provides for that protection. It doesn't, and we have, and I know the commissioners on the call. I've had several conversations with the associate commissioner on the bill. I don't believe that they believe the bill changes what they're doing today in any event, but the bill does just clarify that both types of policies are required. I don't want to speak for the commissioner. I know she's on the phone, but that is my understanding of their position on it.
I appreciate it. Thank you.
Okay, so let me ask this. So when we, from the insurance end, this RRG or whatever it's called, this risk retention group, I mean, to me, that's like a pool of insurance money, right? These people, when I say they pull their money together, is this new ground? I mean,
we've had, go ahead.
I'm sorry. No, you go ahead, Bob. I apologize.
I was going to say, this is something where we've had an NAIC model on the books for several years.
okay.
What it is, unlike a normal admitted insurer or a surplus lines, these are not companies that sell insurance to anybody. These are this is an insurance group that is wholly owned by the companies that are providing these services. It's a self-insurance pool is what it is.
And I guess my only concern is, and maybe I'm, is could the insurance pool run out of money and not be able to pay the claims. Yes,
So-
I can help you with that if you'd like me
thank
to.
yes,
So-
please.
These groups are regulated by their domestic insurer. So the thing that is unique about a risk retention group is the federal law that says that a risk retention group that is domiciled in one state has to be given permission to operate in all the states. That's the unique feature. But those risk retention groups are regulated for solvency like every other insurance company. They may have laws that affect them as a captive. So sometimes the laws and the rules about how much money they have to have on hand is a little bit different because, as council just mentioned, they don't sell generally to the public. They sell to a smaller group, but they have to meet solvency standards, investment standards. They are examined and regulated like any other type of risk-bearing entity by their domestic regulator. And the state of Maryland does have a very limited authority to step in if we feel that the domestic regulator is not regulating them, as they should. So if we feel that they're on shaky grounds, then there are limited action we can take. But in this case, what Ms. Harding has said is true. This just makes it clear that when the the person that's selling the warranty or the service contract is buying their backup insurance, their clip, they can buy that clip from a risk retention group or an insurance company or any other entity that is authorized to sell them in the state.
So essentially, this gives them some flexibility.
It is very common in this space to have the clips sold by a risk retention group, that these servicing companies tend to come together in order to create a risk retention group. And frankly, they may reinsure part of that liability, but this is a very standard format that gets used. And so if there was any uncertainty about whether a risk retention group would do this, that clarifies this because it allows them to consolidate their costs. The premium is going to be less for them because it's a risk retention group than a commercial insurer.
Okay, thank you. But will that stop the phone calls for me on my older caller now?
Make no representation.
Just kidding. So, are there any other questions? Thank you, Ms. Borain, by the way. Thank you very much. Are there any other questions? So, Bob, is this clean? There are no amendments for this?
There are no amendments on this bill as it in its current state. Nope.
All right. So is there a motion to move this to the committee? Delegate Aarons, I see you have a question.
Yeah, I did. Hey, Bob, tell me why somebody wouldn't want this bill.
Really, there is no testimony on that that I saw, but essentially what you're doing, not trying to mischaracterize anybody. You have the general commercial insurers that sell to anybody. You have the surplus lines that we had the bill a minute ago that sell at higher premium for higher risk, primarily for commercial and for some residential. In this case, this is a large self-insurance group. I mean, we've had historically a number of areas where people have come together to form a risk retention group or something like it, like a captive insurer, to cover markets that they didn't feel were adequately addressed by the surplus lines. Medical malpractice liability was one area where risk retention was done, one of the earlier models, and some of the product liability where you had manufacturing defects alleged, design defects alleged. That's why they put together these groups. But essentially, this is an insurer. It's just that the insurance is only being dealt with and paid for by members of the industry, as opposed to sharing it with, let's say, home builders, which is what you'd be doing if you're using a commercial insurer. So I mean,
That gives me a better understanding. Thanks.
If I've misspoken, please, Commissioner or Ms. Harding, please let me know. But
I see.
Bob, you are exactly right.
Okay. See everybody shaking their head. All right. So if there aren't any other questions, is there a motion to move this bill favorably to the committee?
I make that motion, Ned, as stated.
Second.
Okay. Is there anybody opposed to the bill? Seeing none, we have one excused, Delegate Pippy. Seeing none, everyone, it's unanimous. So that
That's it for the day.
that ends our agenda. I will see everyone on the floor in about a half an hour. Thank
I
you.
see you. I see you all at 1 o'clock. Thank you.
Thank
At
Thank you.
1.
you.
Thank
Bye-bye.
you,
1 o'clock.
thank you.